morning, everybody, and welcome to this morning's conference. And very happy for all of the audience to get the opportunity to speak to various executives and experts in the sector. As Steve said, I proudly led this company for the last 6 years since we were a little private business. We listed on the stock exchange in 2005, and we've grown to become the $40 billion property owner and manager in Australia, second largest to Westfield by value, with over 1,200 properties. And we're very proud to be offering all of our investors a diverse range of commercial investment opportunities across sector-specific industrial and logistics funds, office funds, and diversified investment opportunities. There's no doubt we've been through an unprecedented few months, both from an economic point of view. Clearly, this has been a health pandemic. It's very pleasing to see Australia has managed the health risk very well, and I commend all levels of government on their leadership in that regard. From our perspective of Charter Hall, for over a decade, we've been leading 2 or 3 thematics that I'd just like to touch on today, which have put us in a very strong, resilient position to navigate the pandemic and also to navigate and provide our investors resilient dividend yields coming out of their investments with Charter Hall now and into the future. A few of those thematics that are important. The first one is we've really led the charge in what we call long WALE property investments. WALE is an acronym. WALE stands for weighted average lease term to expiry. In simple terms, it means the average remaining lease term on certain contracts with our tenants. Many of our long WALE assets and portfolios have maintained their WALE despite the effluxion of time due to the active asset management of our team in being able to extend those leases and then grow those portfolios accretively with new long leased assets. The other thematic that's very important to us and has been for a decade is to focus on tenants who are leaders in their industry. We want to have resilient tenants. We want to have tenants that grow. We want to have tenants that take advantage of cyclical opportunities. So when you go through and look at our tenant register, you'll see the leading brands and the leading tenants in each of the sectors. One of the third thematics that we have focused on in the last decade has been a very strong focus in industrial and logistics, and within that portfolio, focusing on non-discretionary retail and supermarket anchor tenants. We're now the largest landlord to the 4 major supermarket operators in this country: Woolworths, Coles, Aldi, and Metcash through their IGA network. That's not an accident. That's been a deliberate strategy with over $10 billion in industrial and logistics. That nearly 40% of that leased on long-term leases, those 4 major supermarket operators. And as you would have all seen through the health crisis we've just been going through, we have all, I think, seen the value of non-discretionary grocery-anchored retail. From a sector perspective, we've always been proud to be able to offer our investors an exposure to industrial logistics, office, and one of the other sectors that has become a dominant part of our $40 billion portfolio are long WALE convenience retail assets. That has been, if you like, reflected in a series of transactions that we've conducted over the last 10 years, with long leases to Woolworths, long leases to AP Eagers in the automotive sector, long leases to the major dominant service station operator in BP, which we announced last year. But we've also been doing this in less known sectors, people like Sewers, which is a major waste management company. What you'll realise during all cycles, waste management is still going to be a critical part of all economies. I think there's a lot of talk around what is the future valuations in property. What I can say is that despite the volatility in the stock market in all sectors, including real estate, what we're seeing with that long while resilient thematic, that our asset valuations are quite stabilised. Many of our long leased portfolios continue to see valuation growth during this period. Many of our customers have actually benefited from increased sales during that period. I mentioned supermarkets. We're also a very big believer in Bunnings as the dominant retail player in hardware. I think you would have seen from Wesfarmers' recent results that business continues to thrive. The other thing that's important is that when we look at all of our sectors, we've had a very strong focus on not only strong corporate tenants, but also government tenants. You see that manifests its way in the high exposure to government tenants in assets or funds like our PFA office fund. Likewise, in our direct office fund, and some of our industrial and logistics portfolios also boast long leases to government tenants. The other thing I would say is that during the volatility we're seeing in the stock market, and given that we're virtually all getting negative real returns by investing our cash in term deposits, we see the 5.5% to 6% dividend yield that you can get from investing in unlisted property with some rental growth, and ultimately we believe there'll be stable capital growth. That's going to be, in a relative sense, a very attractive place for investors. We, as the largest manager of external equity investing in the commercial property market in Australia, are seeing equity flows from all sorts of segments. We continue to get flows from Australian superannuation funds. We continue to get strong inflows coming from global sovereign wealth funds, global pension funds, global insurance companies. We recently announced a joint venture to buy the $648 million Audi logistics portfolio on a triple net lease back to Audi, and we brought in a joint venture partner called Allianz Real Estate, one of the largest global real estate investors in the world. And that partnership was a partnership between Allianz and our large wholesale industrial fund. So that's just giving you a bit of a snapshot of where global equity flows are seeing, or what we're seeing in terms of appetite. What I always find remarkable about global investors is they don't need to invest in Australia. So when they do, and they're telling us that Australia is still rated as one of the highest priority markets for them, that tells you on a relative basis, the Australian economy and the Australian commercial property markets look attractive relative to many parts of the world. So those of us that live in Australia should see that as quite a compliment for the growth and the resilience of the Australian property market. Lastly, from my perspective, we have nearly 600 property professionals in Charter Hall. It's been in our DNA from our foundation in 1991 to manage other people's money with care, focus, and two thematics that are very important to myself and the whole executive team: growth and resilience. So everything we do here at Charter Hall is about protecting the capital of investors, giving them, as I said earlier, a good dividend yield from their investments, but also focusing on providing continuity of cash flow and to provide some modest capital growth to complement those very attractive distributional dividend yields. So for me, just in wrapping up, I would just like to give you confidence around your investment in Charter Hall, confidence around any prospective new investment you may make. We think the property markets are in a solid position, despite the fact that there's no doubt there's going to be some challenges economically. We think good quality, unlisted commercial property will outperform over a long period of time and will provide that low volatility, sleep at night type thematic that I think has held our unlisted property funds in good shape over the last 30 years since Charter Hall was founded. So for me, once again, thank you for taking the time to dial in and listen to the panel of speakers today. And as Steve said, if there are any questions, please reach out to any of the people at Charter Hall, and we'd be more than welcome to have discussions about your appetite and how we might be able to provide a sensible investment solution for you. So for me, I'll sign off now and wish the rest of the panel and the audience a good day listening to the expertise that's on offer.
Thank you for that update, David.